I have a confession to make, guys. I have commitment issues, okay? I'm admitting to it. I'm being honest about it. I can't commit to a coffee order. One day it's black brewed coffee, the next it's an iced espresso. I can't commit to a gym membership. It's either I have to go to Pilates 6 days a week, or I'm a hot yoga baddie, or I'm going and I'm lifting weights in the gym. I literally cannot even commit to like a skincare routine. One day I'm all natural and using aloe vera as my moisturizer, which is a great moisturizer. But then the next I'm using all of my drunk elephant. Like, I don't like to commit to one thing. So the idea of picking one stock and just being like, yeah, I'm going to trust you with my whole future, with all of my money. Baby, be serious. I need options. I need variety. I need flexibility. I want to date the whole stock market, not just Apple. And that is why ETFs are my personal love language. Someone told me one day, you don't have to pick one company. You can have them all. You can have the best of all worlds. And I was like, you can't be serious right now. You can buy just this little thing that owns like everything. And suddenly I got to invest and I didn't even have to make a scary decision, because we all know I'm horrible at making decisions. ETFs are like the finance bimbo investor's secret weapon. Hold up though, like take a step back. WTF is an ETF. Like, what is that? Why is this perfect for us girls with commitment issues? Like, I don't even ETF. That sounds like an IUD. Georgie, explain. Well, welcome back to Girls Have Money, guys. Today we're talking all things ETFs. What the hell are they? What does that mean? Do I need to be purchasing that, investing in that? How do I even invest? Where do I start? I don't know what any of this means. Don't you worry. I got you. Okay, ETF, that stands for Exchange Traded Fund. And don't get scared, those are big words, I know. We're going to break it all down. Basically, an ETF is something that you can buy and you put your money into, and it's investing. An ETF is something you invest in. And an ETF is like the ultimate lazy girl's guide to building wealth, if you do it right. And today we're going to talk all things what it is, how it's different from other things you invest in, why it's perfect for us girls with commitment issues, and how you can start investing without giving yourself a stress rash. You don't need any background. You don't need to know anything about investing. All you just need to do is grab a nice coffee, sit down, and listen. Starting with the very, very basics. So we have the stock market, right? And we know that in the stock market, there's all of these different companies, public companies. So a public company is a corporation or company who has opened up its ownership to the public. So they've said, okay, we want to raise money or capital from people in the public. And so people can go into the stock market and they can buy a share or a little piece of the company. They can give their money to that company for the company to use. And in exchange, the person that purchase that little bit of the company, for instance, us investors, you either make a little bit of a dividend, which is you make a little bit of money when the company goes up in value, or you make money when the company goes up in value and then you sell your share of the company. Basically, the stock market is where public companies go and get money from the public to invest in the business. Not all companies are public. There's a lot of private companies. But public companies are much larger businesses like Nike, Apple, Facebook, which Facebook is actually operated under Meta, Amazon, Tesla, like all of those big companies. So an ETF is something that is part of the stock market. Now, maybe you've heard of stocks, you've heard of index funds, you've heard of mutual funds, and they all are things that are bought and sold in the stock market, but they all operate a little bit differently. So I'm going to explain all of this using an analogy of Sephora. Imagine you're walking into Sephora and you're on the market for some new makeup products, but there's a lot of different products you can buy and there's a lot of different ways you can purchase those products. So starting with stocks, you walk into Sephora and you have your sights set on buying just one specific product. You want a full size of Rare Beauty cream bronzer, and you go in and you're betting on just that brand. You're betting on just Rare Beauty and that product, the bronzer. So whether you've purchased it before and it's done you some good work before, it's made you really tan, or you've never bought it before, whether it's great or it flops, like you're betting on just that one product. So if the product flops, your makeup flops. But if the product does well, then your makeup looks great. So you're buying when you buy a stock, you're buying a little part of that company. So let's say you buy stock in Rare Beauty. You're buying just a tiny, tiny little part of that company, like 0.0000001%. How much you buy depends on how many shares you buy, but typically you're buying just a very, very small amount. Stocks are very high risk, high reward because you're putting essentially all of your eggs into that one brand, into that one basket. So if that brand does well, if that company does well, then you will do well. But if that company doesn't do well, then you'll lose everything you put into it. Stocks also, you can trade all day. So you can buy a little piece of a company in the morning and then sell it off by the evening. Like you can, as long as the stock market's open, you can buy and sell that stock. So a stock is just one product in Sephora, and that one product from that one brand, whether it's full size, mini size, whatever it is. The next thing is an index fund, and an index fund is like a bundle. It's like a bundle that tracks Sephora's like top 100 bestsellers. So you are not, when you're buying an index, you're not picking your own favorites. You're just buying the bundle that Sephora is selling. So Sephora made a bundle of their top selling brow products. So they've got a mini size of like the Ordinary Brow Serum and Refi Brow Gel and NYX and whatever. Well, I guess Sephora doesn't sell NYX, but you get the gist. Like they're selling a bunch of their best-selling products and they're copying what's already proven to work, and they're just putting it into one little thing that you can go in and buy because maybe you don't know what brow product you need or you don't know what brow product you want, but you know that these bestsellers have worked pretty much for a vast majority of people, so you trust it. An index fund is just like that. It takes the top or like best-selling stocks or the top companies, and it bundles little pieces of those companies all together so you can just buy that bundle. Now, there's two different kinds of index funds. There's ETFs, exchange-traded funds, and mutual funds. So like I mentioned with the top 100 like bestseller products, a fund matches a specific stock market index, which is just a list of companies. So an index fund will track like top companies. So, for example, the S&P 500. Now, I'm guessing you've probably heard of the S&P 500 because it's very popular and people use it to track how our economy is doing. And all that is, it's an index and it tracks the performance of the stocks of the top 500 companies in the United States. So the top 500 biggest, best performing companies, it tracks the stock of all of those. So when you buy a little part of the S&P 500, you're buying a little part of all of those 500 companies. Think Apple, Amazon, Starbucks, Netflix. And when people say the stock market is up or down, they're often talking about the S&P 500 because it's like a report card and it's showing how these 500 biggest companies in the US are doing overall. It's made up of a bunch of different sectors: tech, healthcare, fashion, banks. So it gives a pretty broad and diverse picture of the US economy. Some other big indexes are like the NASDAQ and the Dow Jones. The NASDAQ You can think of it like the cool tech girl that lives in San Francisco, like all of her friends that live in Menlo Park and work in tech. It's full of companies that are all about technology, innovation, growth. So think like Apple, Microsoft, Google, Amazon, Tesla, Meta. The NASDAQ has over 3,000 companies, and they're all heavily tech and innovation focused. It tends to be a little more volatile, like have bigger ups and bigger downs, because tech stocks are just moodier. That's how they like to act. And when people want to watch the future of tech, they'll watch the NASDAQ. Then the Dow Jones is like the OG business squad. It is the grandma of stock indexes. The Dow Jones tracks the 30 most iconic, most established companies in America. So think Coca-Cola, Nike, McDonald's, Disney, Johnson & Johnson. It's a lot more old school, a lot more stable, and focuses on blue chip companies. Blue chip companies are just companies that have been around forever and are not going anywhere in the near future. Now, it only includes 30 companies, which is, pretty small compared to the S&P 500 and NASDAQ. But these companies were chosen because they're thought to represent like the US's core industries. So these top 3 indexes: S&P 500, Vibe, besties in all industries, 500 companies, and the focus is on the overall US economy. The NASDAQ, the Vibe is Tech Girl Squad, 3,000 companies, and the focus is on tech, growth, and innovation. Dow Jones, Vibe, classic, reliable, 30 companies, and focus is on old school, established blue chip stocks. So when you buy an index, going back to our index talk, when you buy an index, you're buying pieces of all of those companies in the index. So if you buy a piece of Dow Jones, you're buying a piece of Coca-Cola, you're buying a piece of Disney, you're buying a piece of McDonald's, etc. So I mentioned there's 2 different kinds of indexes. There's ETFs, exchange traded funds, which is what this episode is mostly about, and mutual funds. So we'll start with ETFs. ETFs, back to our Sephora analogy, is like one of those clean girl essential makeup sets. It includes multiple full-size products all bundled together. So you don't do any work and you can purchase multiple brands in one cute package. An ETF is similar in the sense that it trades like a stock. It has low fees and is chill and lazy girl friendly. You want to be a clean girl, you just have to buy the package and you already have all the products you need to be a clean girl. Now, this is different from a mutual fund because a mutual fund is like walking into Sephora and having a beauty advisor hand pick a routine for you. So with an ETF, you're kind of just placing your odds, your bets into what Sephora thinks are the best products to be a clean girl, regardless of who you are or your personal preferences, what your skin is like, all of that. But with a mutual fund, you're having someone look at your skin and tell you what they think would be great for you personally. Analogy. So with an ETF, you're picking an index or you're picking a group, a bundle of companies to fit in your portfolio that someone else has curated, and it's kind of just like a one size fits all. But with a mutual fund, you have a personal advisor. You have someone that's bundling together stocks for you based off your personal portfolio. So a mutual fund is much more hands-on, and it usually costs more. It may or may not be better for you, but you are paying for the convenience of someone actively managing that fund, or like in Sephora, managing your basket, managing the products they pick out for you. So the fees are much higher because you have that convenience, that personalization, and it may or may not be better for you. So maybe you would save some money by scouring the Sephora shelves or scouring the stock market for the stocks or the products that are best for you. But you're paying for the fees of a mutual fund because you're paying for the convenience of someone actively managing your basket for you. Now back to our ETF talk. Why do people like ETFs so much? Well, they are relatively low risk because there's pieces of multiple different companies. So there's not such big ups and downs and such big fluctuations like you would have with one stock, because the entire index kind of averages out based off of all of those companies that are in the index. There's also pretty low fees that come with ETFs and pretty low stress. ETFs are a lazy girl friendly strategy. Now, ETFs versus picking stocks. With picking stocks, you kind of need to know what you're doing. If one stock flops that's in your portfolio, your whole portfolio will feel it. You feel the fluctuations from stocks a lot more. But with ETFs, especially if you're picking one of these big indexes, these popular indexes, you know that they're trusted and that someone is watching them closely and you don't need to watch them that closely. With ETFs, you're buying pre-made hot girl essentials and just calling it a day. It's very low maintenance. But with stocks, you might want to do a little bit more research into that company and make decisions that are more tailored to you and your portfolio goals. Now, you might be like, Georgie, this is great. Like, love learning what an ETF is, but what do I do with this information? Like, where do I even start with investing if I want to get started? Now, I'm going to have a quick disclaimer. This is not investing. I'm not telling you what to do with your portfolio. I'm not telling you how to invest. I'm simply offering some learning, some information. So if you were interested in getting started, you would know where to start. I'm by no means telling you to put your money in a particular place. Now, how do you start with investing? You're going to have to start with something called a brokerage account. You can think of a brokerage account as like your Sephora account. So in order to check out at Sephora, you need a Sephora account, right? You need some sort of identification for you and your purchases. And, that's how Sephora knows that it's you buying it. You can't just Venmo Apple and say, hey, can I buy a share? You need to go through a broker, which is like the middleman or the app that connects you, the investor, to the stock market. So you have your bank account, and your bank account holds all of your cash, but then your brokerage account holds your investments, so your stock purchases, your ETFs, bonds, etc. You put money into your brokerage account, like kind of like you're loading up your Starbucks app or you're loading up your Sephora account or something like that. And then you can use that money that you've loaded into it to buy things in the investing world. Important things to know with a brokerage account is it's yours. You can add or withdraw money anytime. You can invest in anything from stocks to ETFs to bonds. However, you will have to pay taxes on gains, which is just taxes you pay when you decide to sell your investments. There's lots of different options for brokerage accounts. You can go to lots of different places. There's some big ones like Fidelity, Vanguard, Charles Schwab, Robinhood. These are all big platforms, but there's a plethora of places you can go to get access to the stock market. The important thing is to do your research. I would advise you to, talk to your parents and ask what their advice would be for a brokerage account. That's what I did when I opened my own. And then all you do is you connect it to your bank account, you deposit money into the brokerage account, and then you can use that money to buy whatever investment you want. And you can literally start with $5. You don't need a ton of money to start investing. Now, you'll look at a stock or you'll look at an ETF and you'll see like, oh my gosh, one share of this costs hundreds of dollars. How could I ever afford this? But the beauty of the stock market and your brokerage account is you can buy just a slice of a share. Like, you can walk into the grocery store and you can take one cookie out of a pack and just buy that one cookie instead of the whole pack. Now, I know you can't do that in the grocery store, but that's what you can do in the stock market. The best part about this is you can start at any time from anywhere. You can skip buying your Starbucks for one day and just put that into your brokerage account and buy a little slice of an ETF or a little slice of a stock. The best part about putting just a little bit money in is it just gets you in the game. And if you're doing this consistently, like putting just $5 in a week or $5 in a month, it reinforces the habit of investing. And the best part about investing is compound interest. Whoa, hold up. Compound interest, that's a lot of jargon. Like, what does that mean? Compound interest, now bear with me. It's interest that earns interest on itself. So instead of just sitting there like a pile of cash, the money is growing every single day. So you're earning interest on the interest you already made. It's like a snowball effect. So you put in your $5, but as the money sits there in whatever stock or ETF it is, it gains even more traction, it gets bigger, and it grows faster without you doing anything. So the market goes up over time. Over the entire course of the stock market, the market always goes up. So if you put your money into the stock market, if you leave the money in there, the profits you make also start making more profits. It's like your money's at the gym lifting weights, and then the muscles it grows also starts lifting weights. And the longer you leave it alone, the more your money works for you without you doing anything. Super basic. You make money, you leave the money in, that money makes more money, that money makes more money, and it keeps repeating like a never-ending cycle. So when you're just putting in a little bit of money consistently and you're leaving that money in there, even if it's just $5, the longer you leave it in there, it'll pick up more speed, it'll snowball, and that $5 will make more and more and more money over the long haul. That's the beauty of compound interest. We love compound interest. Hot girls invest early and often, no matter how small. I don't care if it's $1, like a tiny little bit. Now, what do you want to look for when you're choosing your first ETF? The first thing is low fees. So we're going to get a little bit technical, but you can totally tune this part out if you want. If you're interested, look at the expense ratio. So this is what you pay each year to own the ETF. It's a very small percentage, but it adds up over time. So with anything in the stock market, you have to pay a little bit of fees, but that's okay because your returns typically will outweigh those fees and make it worth it. And it'll be much better than just sticking your money into a savings account or sticking it underneath your mattress. So, looking for low fees. Aim for something under 0.1% if you can. For example, SPY, which is the index that tracks the S&P 500, its fee is 0.09%. So the fees are typically not that much, but if you want to get a little bit technical, look at the expense ratio. The second thing you want to look for when choosing your first ETF is a diversified index. What is a diversified index? That just means that index spreads a share or spreads its money across lots of different companies in different sectors and different industries. If it's diversified and if it has little pieces in a bunch of different industries, it's much more stable than putting all of your money into one particular industry. Because typically when some sort of economic crisis happens in one industry, all of the companies in that industry will feel it. But if you're diversified, then you can balance out those downturns a little bit more. Sometimes it's really tempting to go for trendy ETFs that are really big in the news. Right now, AI and crypto are really big, but when you're starting out, it's better to just go with boring and reliable. You know, we're trying to marry the nerd, not the motorcycle bad boys, okay? Now, it's important to remember that you're not going to become rich overnight. That is not what we're aiming for, okay? We're not those finance pros that are trying to beat the market, because beating the market, no matter how smart and how skilled you are, is very difficult. We are here for the long-term strategy. You're going to set it and forget it. Put your money in and then close the app and never look at it, okay? Leave it alone. Don't take it out. Don't stress out about it. When the market goes up or down, you're just going to be calm and go on with your life, okay? Day trading is not long-term investing. day trading is like going to Vegas for a frat formal, okay? It's crazy. People are very emotional, and formal either goes really, really well or really terribly, okay? Long-term investing is like going on a girls' trip to Lake Tahoe. It's relaxing. You know it's going to be great. You know it's going to be peaceful, and you know you're going to come back rejuvenated. And that is our ETF talk. That is what the stock market is all about. And if you're like me, you're probably like, why is no one talking about this? Like, why did we never learn this in school? Why do I have to go and do my own research and study the stock market when I already have like 50 million textbooks to read for school? Like, we had to take geometry but not learn about this. And to that I say, I completely agree. I think it's very unfortunate that we don't learn personal finance or we don't learn anything about the stock market in school, especially in high school. That's definitely a gap, but that's why we're here. And we're here to talk about it, to get rid of all the finance bros and to make it really approachable. That's the ultimate goal with Girls Money, is to help you take control of your finances and learn everything there is about the markets, about the economy, and how you can take advantage of it. And the earlier you start with investing, the greater your returns will be by the time you sell off your investments. Our whole goal here is to take a long-term approach. So we're putting money in the stock market and we're going to keep it there until, probably until we retire. And that's a long time. I know you're like, why am I tying up hundreds or thousands of dollars when that I can't have until I'm 60 or 70? But compound interest will make those thousands of dollars millions of dollars. And we're setting ourselves up for financial wealth and success so we can retire peacefully and we can have financial security. Finance bros love to make all of this sound complicated, but honestly, it's not. It's not that complicated. Everything in the finance world is just painfully gatekept, and people in finance love to, sit on their high horse and explain it in a very jargony way, but that's not fair. And or the rest of us who are media majors or Spanish majors or elementary ed majors and don't learn about this in our classes, okay? It is hot to be financially literate, and you don't need to be a finance major to understand any of it. The other point I want to touch on is you might see lots of influencers on TikTok or on Instagram that are dishing out tons of advice, like honestly, just like I'm doing here. But the most important thing to remember is to not trust anyone completely. Take every piece of advice with a grain of salt, read it, watch it, listen to it, think about what that influencer or that person is saying, but follow your own guide and your own instincts and make decisions that are right for you and your portfolio. You are in charge of your own investing journey. So make decisions that feel right to you. Do your research. Learn here and learn as much as you can everywhere else. I will always encourage you to read and watch as much as you can to make financially sound decisions. In terms of influencers, though, I am a big fan of Nicole Lapin. She is a money expert and a previous news anchor, and I would suggest her as another place to go for learning purposes only. She has great advice, and a piece of advice that I've taken from her and I actually use myself in my day-to-day life is about investing in brands instead of buying the product. So basically, she advises people, women, to consider their purchases. I'm not speaking English right now, but to think twice about their purchases. So for example, let's say I'm out shopping today and I see a new pair of Lululemon joggers that I love. They're so cute. They're adorable. Maybe I don't necessarily need them. I mean, I do have 3 pairs of Lululemon leggings, so they're not necessarily a necessity, and they're an expensive purchase. Lululemon is expensive, especially for me who's on a college student budget. But they're so cute and I really want them. So what I'm going to do is I'm going to hold off. I'm going to go online. I'm going to take a screenshot of the joggers and stick it in my phone and go home and sit on the purchase for a few days. But when I get home, I'm going to go into Google and I'm going to Google index funds that have Lululemon in them. And I'm going to find an index fund that I really like. And instead of purchasing those pants, I'm going to invest in that index fund. You could take this two ways. You could either just invest a little bit of money into the index fund and sit on the purchase for a few days, or sometimes what I do is I invest the full price of that product. So if the joggers were $110, I'll invest that $110 instead into the index fund, and I won't buy the pants. And the best part about this is you make returns on investing in that index, in that ETF, and you will reap the benefits of that for many, 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 many years to come, instead of buying the pants that, maybe you would have worn 4 times before reselling on Depop for like 10% of the price. So I love her piece of advice on that, and I think it's great to think twice about the purchases you make. Not saying don't buy things that you want to buy, but it's great to, spread out how you spend your money a little bit more. And I'd love to know what you would put in your own index fund. Like, if we were to make our own, what brands would we want in it? I think I would want to put like Ulta, maybe Lululemon, Abercrombie. Oh, I definitely would have put Aritzia in my index fund. Like, if I could create my own index fund with a bunch of companies I love, I would maybe put Tesla in there, Olaplex. Can't remember if I already said that. I think I did. Victoria's Secret would be cool. I like Nike because Nike owns Converse, and I love Converse and Jack Purcell's. Oh my gosh, throwback to Jack Purcell's. I used to wear this all the time in elementary school. I think we should totally bring those back. Those were really cute, especially the slip-on ones. Okay, anyways, another piece of advice that Nicole Lapin shares that I'm going to repeat here because I think it's great advice is to make a habit of investing. I do this myself. So set aside a little bit of money every single week, set a reminder on your phone, and invest that much every week. So I have a reminder in my notes app. Every Tuesday morning at 9 a.m. it says invest $10. And I go in to my brokerage account, and every Tuesday morning I invest $10 into an ETF. What this does is not only does it get you in the habit of investing and putting money into ETFs and maximizing those returns, but it also eliminates some of those market fluctuations. So, we have, like you probably hear in the news, we have a lot of market fluctuations. There's been a lot recently because of a lot of the tariffs we have going on. And by investing just a little bit over a long period of time, you are eliminating some of those big fluctuations. So let's say instead of investing $40 at the beginning of the month, where you might be just catching the market at a high or catching it at a low, if you invest instead $10 every single week during that month, you're balancing out the highs and lows that happen throughout the month. So you're sort of flattening the curve that happens in the market. Okay, I'm going to go and transition and answer some common questions that I think that you might have after all of this ETF talk. And as always, my DMs are always open, so DM me any questions, comment any questions you have, and I will get back to you and answer them. The first, do I need a financial advisor? My answer to that is no, not unless you want one or you have a complicated financial situation. So there's a lot of factors that go into investing, right? Like, you have to consider the debt that you might be holding on to, your income level, your financial commitments like rent or groceries. There is no simple answer to managing your money, but you don't need an investor simply to gain access to the markets. You can gain access to the markets all on your own with just a brokerage account. So if you're 20 and you have no debt and you have some money that you won't need, key point that you won't need for years to come, a financial advisor might just tell you to buy a low-fee index fund and invest a little bit consistently. But if you have lots of money to manage, or you're navigating inheritance, taxes, divorce, whatever else, or you want help with long-term planning, an advisor is really helpful to navigate those. Everyone has very unique financial needs and very unique ways that they want to maximize and utilize their money. So it's very case-by-case basis. If you're just like me, and you just want to invest $5 every single week and you have a little bit of spending income that you want to put into the stock market, you can do that just with a brokerage account. But if you have other obligations or other, financial concerns, then an advisor would also be helpful for that purpose. Second question, can I lose all my money? Realistically, only if you do something really reckless, okay? So a diversified ETF, we're talking about those because you will only lose all of your money if every single company in that index goes to zero. If you just put your money in that ETF, leave it alone and let it grow, and you don't invest money that you're going to need in the near future. So another key point with ETFs is you want to put your money in and then leave it, not take it out, not sell it, nothing like that. Because if you end up having to sell it, you're going to have to pay taxes. And depending on where the market is at the moment, you might ultimately lose money. You will only lose all of your money over the long term if all of those companies go to zero, and the chance of that happening is very, very slim, okay? But you're leaving your money in there, okay? Now, third question, what if the stock market crashes? Crashes are temporary, long-term growth is not. Historically speaking, the market has always bounced back. So if you are playing the long-term game, like we're talking about, and you're leaving your money in the market alone, you will be okay. Market crashes are scary in the moment, but if your foundation is strong, you have a good mindset about it, you don't get too emotionally involved in your investments, you will be okay. Don't panic sell when the market crashes. If you are diversified, just leave your money in there. In fact, sometimes crashes are when millionaires are made because the market is quote unquote on sale and smart investors buy indexes at discounted rates. But we're not playing the market here, okay? We're just leaving it alone and we're taking the safe route. Now, fourth question, what's the difference between active and passive investing? Active investing is when you're trying to beat the market. Like, we're a 20-year-old finance bro in Pike who is trying to make big bucks. It doesn't necessarily work, okay? When you're trying to beat the market, you're constantly watching and timing trades. It's very high effort, high maintenance. It requires a lot of skill and a lot of risk. That's not us. We're not trying to be active investors. Instead, we're passive investors. We're buying it and we're forgetting about it. It's less stress, it requires less knowledge, and it gives us slower and steadier growth. Now, I touched on this a little bit earlier, but are ETFs taxed? You get taxed when you sell your ETF. So when you decide to sell off your investments, you will pay a capital gains tax. If you owned that ETF, that index, for less than a year, it'll get taxed as regular income. That's a higher tax. Then, if you own it for more than a year, then it'll get taxed as a long-term gain at a lower rate. But regardless, yes, you will pay taxes. But that's why we want to let compound interest take the reins, and we'll sell it in many, many years to come when the tax won't really impact our gains. And our final question to close out this episode. Why is investing always explained like it's for finance bros? Don't even get me started. I know. It's annoying. But you know what? The stock market and finance is not just for guys. For a long time, it was, okay? Finance has always been this weird kind of closed off boys club. And the more complicated everything sounds, the more people think they need an expert to do anything money related for them. And that's how a lot of people in finance make their money. They make things sound complicated so that people will pay them to manage their money. The truth is, you don't need to do that. You can learn about finance all on your own. You don't need to be a finance major. Yes, I'm a finance major, but I'm a finance major here to help you guys. So you can follow your dreams, you can have the career that you want, and you can also understand how to make the most of your money. You just need to know the basics and be open to learning. Investing and finance is for anyone and everyone. It has a little bit of a learning curve. Yes, there's jargon. Yes, there's weird terms that just don't make any sense at first and that are going to be mansplained to you over and over and over again. finance bros may have made the rules, but the girls are here now. And we're not just playing the game, but we are rewriting it. And we are building our own wealth. So that was today's episode of WTF is an ETF and why should I care? And I'll see you guys on Wednesday for our next episode of Girls and Money.